Welcome to Wall Street Week, the show of record for long-term investing. I'm Anthony Scaramucci.
And I'm Gary Kaminsky. Joining us today is a giant in the world of finance. Jeffrey Gundlach is the CEO of DoubleLine Capital. His mutual funds hold in more than $1 billion last month alone. And when he speaks, markets move. So let's get right to it. Jeffrey, great to see you here.
Thanks.
You and I were together, we were just reminiscing, early February in Los Angeles, right about the time the markets bottomed. And if you remember, everybody was very concerned about the outlook for this year and the outlook for the equity markets as a whole. What has happened since February 11th?
Well, the markets rallied substantially starting February 11th off of incredible bearishness. I remember that the probability built into the market, in the bond market, that interest rates would raise any time during 2016 went to zero on that day. And people were asking Janet Yellen about, should we go to negative interest rates in the United States? And it was just, the sentiment was just black as night. And when that happens, usually the market's pretty sold out. And what we saw is, what we've been seeing, is incredible volatility in the stock market. A huge decline in August and September that brought on very pessimistic attitude, and then a huge rally into December. And then the Fed raised interest rates, and I thought that they would in December, but I thought it would be a bad idea. And sure enough, we got off to the worst start in basically the history of the stock market in the February 11th. But now we've rallied back up on very dovish talk.
Well, you were bullish, but you were buying stocks in February, were you not?
That's right. Yeah.
So why were you bullish, though, given all of that negative sentiment going on?
Just when things look that bleak, usually the market's sold out. I mean, I thought the talk of negative interest rates was shocking, given that the Fed was on record saying at that point that they were going to raise interest rates 4 times over the course of 2016, which I thought was never going to happen. But it's kind of a strange world when you're talking about 4 increases, and yet you're getting questioned as the Fed chairwoman about shouldn't we go to negative interest rates.
Well, that's a good lesson for investors, though, right? That when things are looking bleak, that's probably a good opportunity to buy as opposed to be panicking out of your positions.
Absolutely. The best trades that I've done over my 30-plus year career have always been the ones where your hand's almost shaking out of fear when you're writing the ticket. And that was almost the case February 11th. So, but the problem I think that we're facing here is most markets around the world, our stock markets, are way off their highs. I mean, you take a look at the Japanese stock market, it's been terrible since they went negative. If you look at the European stock markets, they're down 10, 15, 20%. Again, since they went negative, which is really an important thing for people to think about, because negative interest rates in Europe and in Japan were supposed to be stimulative to their markets and to their economies, and they were supposed to weaken their currencies, and the opposite has been happening.
Jeffrey,
and it's really important for
Jeffrey, I want to just say on
that.
equity markets for 1 second. Back on April 15th, Kyle Bass joined us on the show, and he gave us this take on the stock market. Watch this.
When it comes to the stock market, is there anywhere in the world you want to be putting money to invest in stocks right now?
No. If I'm right about China, that means global GDP is going to slow. If global GDP is going to slow, it won't be risk positive for equities.
So you know Kyle, and you heard what he said.
Yeah.
He thinks that this move of dovishness by the Fed since February the 11th, which has created a rebound in the U.S. equity market, is really an opportunity for investors to sell. Your thought is what?
I agree with that. I think that when you're within 1% or 2 of the highs, and you've been going sideways for 18 months, really, and stock markets around the world are well off their highs, the U.S. is kind of the last man standing. And I think what's really unsettling is the great demand that people have for this new flavor of the month called low volatility equity funds. There's no such thing. There's no such thing as low volatility equity funds. It's an oxymoron. I kind of facetiously say class action litigators clip and save, because low volatility doesn't exist in the equity market. Utilities are a great example. Utilities have been great over the last 3 years, have been great year to date, but they're not low volatility. They look like they've been. But during the 00s, there was a drawdown in utilities during that decade of 57%, peak to trough. So I always get concerned when investors are buying something that they think is safe, that underneath it really isn't safe at all. And that's when you really get problems in markets. Remember subprime back 10 years ago, there were AAA rated securities that were floating rate. It looks like there's no risk. There's no interest rate risk because they float. They're AAA rated. There doesn't seem any credit risk. They dropped 80% in value. So I would really admonish investors not to get sucked into this flavor of the month low volatility.
Just have a good broad-based asset allocation plan. Isn't that the best sound advice for investors?
Frankly, I think in our world today, you're better off buying things that are perceived to be risky because at least they're priced like they're risky. You know, one of the things that I like instead of utilities is there's an ETF called REM, which is mortgage REITs, which are utility-esque. I mean, it's a bond surrogate, it's a yield play. The mortgage REIT index and REM has been negative in return since 3 years ago. Utilities are up about 40%. I want the one that's negative over the last 3 years, not the one that's up 40%. And by the way, the yield of REM is 11 and change. The yield of the utility index is 3.03.
And just for viewers, that's like buying stocks on February 11th when most people were selling them.
Yeah, it's a great contrarian play. We're going to have more with Jeff Gundlach right after this.